Sorry, I kept myself muted. Okay, so good morning or afternoon, everyone, depending on where you are. Thanks for joining us on our first of two webinars for today, first of which we're covering off on Asian equities, and then later on this afternoon, we'll be covering off on fixed income and where to from here. Obviously, one of our plans sort of moving into 2021 is to run monthly webinars if possible, sort of these short and sharp ones, no longer than half an hour in total, just to cover off a couple of the main themes. That was sort of the main feedback that we received from you all over the course of the years. We ran a couple of webinars, but there was sort of more shotgun as opposed to sort of giving sort of consistent updates. Obviously, we have all other publications and media releases that you guys get as well, but we thought we'd stick to half an hour here. So I'll jump straight into it in the interest of time. So this is what the world looks like from our perspective today. Obviously, we've got trade tensions, and that's something that is an ongoing issue. And I'm sure someone's going to have a question for me about that. And then we've got the sort of issue of zero rates environment, and that's something that's going to effectively be quite consistent moving into 2021 and beyond. Ultimately, there is no central banker in the world that is willing to have the guts to raise rates, because we all know what the impact will be, and you'll effectively see further weakening or deterioration of economic activity if we do have any slight chance of rate rises. Now, obviously, overall, we know that rate rises are also negative for equities, especially growth equities, but it's still going to be a very constrained environment. Now, that does ultimately lead to a more macro theme of high levels of volatility in equity markets, because people are, either in denial or disenfranchised with low rates. And therefore, people are going to keep putting money into equity. So it is something, a lot of investors are questioning, a lot of advisors, a lot of researchers, even ourselves, in terms of do PEs matter anymore in an environment where rates are at zero? Okay, so it's like gunning for growth at whatever cost. In saying that, I mean, in the market that we operate, being Greater China and Asia, it's far more attractive on a valuations basis, and so we'll sort of talk through that as well. So just a brief update on our fund managers. We're managing at about 12.5 billion at the moment, with effectively split 8 billion in equities, 4.5 billion in fixed income. We've maintained and kept growing our investment team of about 70 people, covering the ground across Shanghai, Shenzhen, Kuala Lumpur, Singapore, London, and Beijing. So we definitely have the feet on the ground and the insights. And the most important thing to remember is, in a period like this during COVID, video conferences are nice, but having people on the ground and having people on the ground in an economy which has gone through that V-shaped recovery is certainly of a huge benefit. And you'll sort of see that through some of the data that we've collected that I'll share with you in a minute. So we still kept up our company visits. We're at 6,500 company visits this year, calendar year. And we'll hit that target again. Again, there's no other fund manager in the world that's covering the region as closely as we are. These are not broker meetings. These are not earnings announcements. These are actually one-on-one meetings that we have with management, IR, etc. And that forms the basis of our investment philosophy for the last 27 years. So very, very strong pedigree, and our local operations have been here for 15 years now. So most of you would be aware that our Asian equities strategy, we decided to consolidate our fees to make it far more competitive for yourselves and your investors. So we completely removed the performance fee on our Asia ex-Japan strategy, and we also reduced the management fee from 1.78% down to 1.33% in the middle of last year. So this is 18 months ago. PDS hit the market 1st of July. And what you're seeing here on the screen is us versus Platinum versus the index. Okay? And what is very important to note is, yes, we are very well aware Platinum is the incumbent, but unfortunately, we believe that we are more nimble, that we have more people and feet on the ground. They don't have feet on the ground, and hence they do not have the insights. And our performance speaks for ourselves. So if you sort of look at this on a year-by-year basis, over the 10 full operating years of the strategy, we have outperformed Platinum in 7 out of the 10 years. We've outperformed the benchmark in 7 out of the 10 years as well. So we have a very strong pedigree, and we'd love to have a chat to you about our strategy. And also, being very frank, we are now cheaper than platinum as well. So one of the first things that we sort of noticed throughout the year, and we've sort of been keeping this chart updated as the year has progressed, here's the spaghetti plot chart of simply the performance of major indices, Asian indices, and then our funds. Okay. And what you notice here is that the biggest lag has been Australian equities, okay, vis-a-vis the ASX 200. Now, for the first time, I think in my entire career, we have seen anyone who's been invested in Asia or Greater China this year has benefited greatly in terms of offsetting negative returns, or being the sort of the one that sort of saves the day for in terms of the conversations you've been having with clients. And that's only because, you know, for better or for worse, if we look specifically at a place like China, it is authoritarian government in power, and therefore its ability to lock down the economy, its ability to then recover out of a crisis is obviously much more effective, much more swift, and much more controlled and contained. If you then consider that even against the S&P 500, it's also been a lagger. So all our funds, both our Asia and our China fund year to date, are both tracking at least 15% year to date versus the ASX 200, which is effectively broken even, and the S&P 500 sort of doing around that sort of 8-9% for year to date. So a lot of advisors have obviously been very, very pleased with their allocations to our funds. Furthermore to that, since we decreased our fees, we've been upgraded across all major research houses, and upgraded to recommended about this time last year. Longset upgraded us in April this year. SQM upgraded us last week. So we're covering off all major research providers, as well as all major platforms, if you want to get on there. Now, for those of you that are on the line that use IWF, we're currently still awaiting a final contract from them, that we are being put on IWF for the Asia strategy. So stand by for more news with regards to that. A couple of you have reached out and called me in the last couple of weeks. For those of you that use BT Panorama, and just like our advice practice, we have migration from BT Wrap or Asgard into Panorama. If you have existing holdings in our strategies, they will migrate over, but they are currently still closed off on Panorama. If you would like to see the funds on, again, it's going to be up to bottom-up support. Please reach out to your BDM. Our next sort of touch point with the investment governance team will be in early 2021. So one of the key reasons why we believe that Asia has sat in a pretty good position, and this is sort of a chart that advisors love to use with their clients when talking about sort of the resilience of Asian businesses, is that using two very simple metrics of looking cash to total assets being the top part, as well as the net debt to equity on the bottom part, you'll see that Asian corporates hold a lot more cash. And this is data spanning sort of 16 years now. And then on a net debt to equity basis, they are the lowest, okay, compared to their Western counterparts. A big reason for this is because they went through the Asian financial crisis of 97, 98. And so what you see there is one of the key reasons why, you know, they have been able to keep themselves above water quite strongly and be able to actually what we call hold the fort in times and crisis where, you know, effectively a lot of their revenues effectively evaporated to zero. But for a very short period of time. One of the other key things we've been doing is channel checking. And this is something that most fund managers actually can't do, solely because they don't have the breadth of data and the access to management for them to be able to sort of put together a better macro picture of what's going on. Now, what you see here is that this is data all the way through to July, and the reason for this is because everything's sort of normalized since then. What we're doing is a mixture of taking macro data plus our own channel checking through the companies that we invest in or the companies that we're interviewing for potential investment. And what you see here is that the government was quite quick to ramp up fixed asset investment in the early part of the year. And then you also seen as a result of that, even the services PMI has picked up quite significantly. So for those of you that aren't familiar with PMI is the Purchasing Managers Index. If the number is above 50, it represents a increase in economic activity, in this case, Chinese services compared to the previous month. If it's sub 50, that represents a contraction. One of the key things for us is looking at electricity production. It was quite interesting at the early part of the crisis. A lot of people, a lot of fund managers that we actually spoke to were monitoring cars on the road. And that was their sort of barometer for level of economic activity. We don't think that was fair given it was a pandemic. We think that was actually a rather odd metric to use. So we use electricity production as a better line of sight for us. And obviously the contraction in March was then swiftly recovered through the next following 4 months. Retail sales still remains to be a lagger. And that's something that we're closely monitoring, but I'll show you some other figures in a minute in terms of the more specific sectors that we're targeting on retail sales. And those have been proven to be much more resilient. Again, we're stock pickers. We don't invest in macro themes. We invest in structural themes and underlying companies that have the competitive advantage to move through business cycles. What is very interesting to note, though, is have a look at new home sales here. New home sales has been very, very strong, okay? Very, very resilient. Remember what this is actually looking at compared to PMI is that this is actually year on year. So all metrics here that are in percentages represent a year on year figure. So what you see here in May with the new home sales growth being just under 10%, that is in comparison to May 2019, not in comparison to April 2020. And that's a very important distinction, important distinction to make. And then here with our channel checking at the bottom here, what you note is that hotel occupancy rates were reasonably recovered quite well as domestic sportswear brands. So we're doing this channel checking, and it's something that's very, very important to us that we're doing literally month to month. Okay. I'll come back to questions. A question has popped up. I will come back to that at the end. So if you consider here then as well, these are two areas that we do invest in very specifically, one being white liquor, which is what you see on the top there, which is Feitan Maotai. So this is the wholesale price. So remember, when you look at the distribution model of wine, for example, you have a producer, and the producer obviously sells it to a wholesaler, okay, at a wholesale price. They then are moving as a distributor to go and put into retail stock shelves. Now, if you think about in an event of an economic crisis across all sectors, you would be considering heavily discounting the situation, or heavily discounting your price to be able to get onto store shelves. And that did occur through the first quarter of this year. And the average price for 53% alcohol rating went from sort of 2,300 down to 2,000. And then it very significantly went past its previous peak very, very quickly since July. And the same thing sort of for sports shoes. Okay, so we have an exposure in sport apparel. And our channel checks have shown that this was also very, very resilient. So the consumption story is very much intact. I want to talk about the mega trend here about consumption upgrade. This theme around the middle class has been talked to death, okay, whether be it by us or by other people. Okay, it's completely irrelevant. Because everyone understands and accepts that for what it is. What is actually more important is that we need to dig a little bit deeper here. And what I mean by that is we need to dig a little bit deeper in terms of who's actually benefiting from the consumption upgrade and how is that actually flowing through to individual sectors, subsectors, and individual products. Okay. What you see here on the bottom is the vertical axis represents the growth in average selling price, okay, versus the average growth in sales volume. Okay, so if your price didn't change but you're selling more, then clearly you're probably more profitable. And if you're selling for a higher price but you're not selling any more than what you used to, then same thing, right? You're increasing your margin and therefore you're increasing your overall productivity. So that's fine. What you see here is that over the last 3 years, you've seen that luxury jewelry and designer apparel, they've increased the volume. Okay, now what does increasing the volume part represent? And increasing the volume part represents the fact that you've got more people being able to buy that good, okay, because the price hasn't changed. Okay, so that proves the theory that there is an increase in the level of the middle class, okay, because they have a high level of disposable income growth. Therefore, they've been able to, for these. At the same time, you've got other sectors that have slightly increased their price, like instant noodles, which we'll come back to because that's a sort of a favorite topic of ours, and we've achieved a fantastic outcomes for investors in that space, as well as spirits. Is that you've seen the actual level of sales volume decrease, but the average price significantly increase. Okay. And that's because they're catering back into the areas of what we call premiumization. Okay, so instant noodle growth in China, if you're looking at the cheapest stuff, it's about 1% growth a year. Think of it like bread. But in the premium space, which we operate in, it's growing at about 12% a year. A very, very different metric and very different situation. So this is how sort of this consumption upgrade is happening. If we then look at individual sort of subsector metrics, what's sort of important here to note? I won't go into a lot of detail here. We'll make these slides available later. A lot of people ask us, well, Jonathan, your fund is now investing in a lot of large caps. Earlier in the early years, we were investing in more into mid and small caps. So why is that the case? That's because the biggest players, the top 3 players in these four subsectors of consumption, are all controlling more than 50% of the market. But the key thing to note, and why we believe that the potential for these companies going forward is very strong, is that the net profit margins are not as high as their overseas peers. Okay, so the Western peers, effectively. So if they're making really good profits now, as they actually increase the efficiency of their operations going forward, this is only going to increase and sort of improve here on out. Okay. Then we also break down the consumption sector and look at, well, which parts is actually going to be the more heavily skewed towards the positive side. All right, so premium baijiu is that white liquor, so the Feitian Maotai, Wuliangye, which we'll come back to in a minute, sportswear, luxury jewelry, as well as skincare. Okay, these are sort of positive. Okay, with instant noodles, the reason why is we don't operate and we don't invest in cheap operators. We only invest in the high-end part of the market. And so even one of the companies that we invest in at the moment in Uni President, which has a lot of sort of consumer-based products like drinks, cold drinks, instant noodles, snacks, things like that, where we've been positive on their business because 3 years ago they had 1,000 SKUs. Okay, so SKU representing effectively 1,000 different products. They realized that that's not efficient, and over the last 3 years they've consolidated that from 1,000 products down to 300. We like that, okay, because you increase your efficiency and therefore you increase your productivity and therefore your profit margins, so on and so forth. Okay, so these are the areas that we like. For those of you that invest in our funds for quite a while, you would have noticed that we have not held an automobile company for 5 years. Times change, we adapt, market adapts. We don't like the automobile sector. There's no margin, market saturated. Government's hitting very hard on the green emissions targets, just like everywhere in the rest of the world. China wants to be carbon neutral by 2060, okay, which is a decade later than what most countries are signing up to at the moment. So these 3 areas, fully saturated, not interested. These areas, high margin, a lot of potential to go. Furthermore to that, the way that people are consuming is also very different. Okay, what this slide is showing you is the service consumption as a proportion of total spending. Okay, so for every dollar that is spent by a consumer, a third of that is done via an online service. Okay, in other more developed, more advanced Asian economies, it's higher, and UK and US, it's even higher than that. So for most of you that have kept track of our funds, top holdings, we're holding Alibaba, Tencent, fantastic businesses, lots of growth, reasonable valuations, and they still haven't tapped the surface yet, as you can see on the slide there. And if you consider that in terms of the penetration rates of these sort of e-commerce services over time, electronics is sort of not even half yet. KTV bookings, which is karaoke, is at 16%. Okay, we know the power of things like taxi hailing vis-a-vis Didi in China, and that's still only 14%. What is the key benefit at the moment that the Chinese have on their side is that they basically jumped from having nothing to having a smartphone. Whereas we went from having nothing to a computer to then having a smartphone. Okay, so we took a while. We also went from going from cash to to credit cards and then to online payments. China went from cash to online payments. Okay? So we expect that the growth and the transition to digital payments to be even faster than in Western countries. So what do they need to get to that point? Well, they need 5G. And one of the things and the reasons why Donald Trump has been so aggressive on China with regards to 5G is because the US can't deploy it fast enough. With the main reason being that the US military uses up a lot of the bandwidth in terms of the frequency bandwidth that is part of the 5G frequency wavelengths. China doesn't have that problem. It's the same thing as India had that problem with deploying 3G because their military was using it. So having to unravel all that before you can actually create commercial wavelength 5G, whether it be the millimeter wave or the other one, takes a lot longer. So therefore, the US has been on a concerted mission to try to slow down the development of 5G in China. But we all know 5G is the game changer. And in Australia, we're starting to adopt 5G here. Even with the latest iPhones, they now have all standard 5G capability. But you see here is that the actual penetration of 5G in China has outsurpassed everyone in the rest of the world. Okay? And that's really important because that's just going to mean things are even going to be even faster and the development is going to be even more effective across Asia and China going forward. And the R&D is not stopping. China's have already overtaken the US in R&D spending, and it's by a long shot already. And China is also the heaviest investor in terms of patent applications across countries. So China has just surpassed the United States at just under 60,000 patent applications for the year. And then in that 5G era, remember there's a lot of growth that's going to happen here. Okay, this RPA is the only one that most people ask me. That's robotic processing and automation, and all these areas are going to be integrally linked to 5G growth. And this is probably the killer chart here. And this is something that I also encourage you to share with clients. Okay, this is the growth of connected devices onto 5G networks. So in 2010, there was about 2.5 billion devices, okay, connected to 3G. Then by 2018, we had 10 billion connected devices to the 4G network. And each of these subsectors is going to mark the next stage of growth, both from a consumer and industrial standpoint, where by 2025, we'll get to 25.2 billion connected devices in 5G. That's incredible. And that's something to really take into account, that this is going to be a game changer for the way that everything we talk to going forward, whether it be via Zoom calls, whether it be by any other medium, 5G is going to be the critical thing for the next decade or so. So in terms of how we've been tracking in terms of our performance against our peers, I showed you what we were going up against the incumbent, which is Platinum. But if we match in our entire peer group under all time periods, 1, 3, 5, 7, and 10 years, we outperform our peer group set at a minimum of about 1.5% over 5 years net of fees. Okay, and most of this time period we were a more expensive fund. Okay, now our opinion is you pay for what you get. There's a reality behind that, being active management. But the other thing to note is that both our Sharpe ratios and our information ratios, which is critical to the way that you construct portfolios for your clients, we also outperform them. Okay, so for those of you that are not familiar with these two ratios, effectively the higher it is the less risk you are taking to achieve the performance that you've had. So in some periods on the information ratio, for example, there's sort of 2 periods over 5 and 7 years where the entire peer group had a negative information ratio, which means you were taking an excess level of risk to actually achieve the performance that you did. What you can see here is that we invest in trends, okay? And the trends are structural changes. We're not talking about fly-by-night sort of situations. We're talking about structural changes in the way consumers consume goods and services. And so you can see here that in our Asia fund, it's 31% consumer discretionary, 25% IT, 14% staples. Okay, these 3 sectors already make up close to 70% of our portfolio. Okay, it's a big deal. And then we have a mismatch of other things. Look at the amount of cash we're holding is basically none, and it's the same for our China fund. What you'll also note in terms of our geographical distribution as well is that The reason why we like Hong Kong, Taiwan, and China, which is this A shares and H shares portion, is because of the fact that we have more confidence in the level of earnings that's going to flow through. You imagine you're investing into other parts of your clients' portfolios, let's say in Western equities, in parts of, say, Europe, where you don't know when the next lockdown is going to happen. Lockdowns happen, your analysis, your forecast of future earnings have effectively been thrown out the window. If that's the situation that you face, then these geographical exposures to us, we want to be invested in the areas where we're confident that they're not going to be subjected to high levels of lockdowns or further uncertainties. Okay? No one likes uncertainty, but we all live with it. But if we can invest in areas which give us high levels of certainty around earnings, that will give us a more, we know where to focus our efforts and therefore how to derive those results for your clients. These are our top 10 holdings for our Asia fund. And what you'll note here is Alibaba, Tencent are those two key e-commerce names. They are different businesses. What I plan to do next year is as part of the monthly webinar set, we'll actually go and do a bit of a deep dive so that you sort of get a better understanding of what Alibaba and Tencent do. Tencent is more services and payment systems. Alibaba is more e-commerce related. Then we are in TSMC as our third top holding, which is the most advanced semiconductor manufacturer in the world. They created the 5nm chip, which is now in Apple iPhones. No one can compete with them. Samsung Electronics, because no one can compete with their RAM technology. The next two are the white liquor names. Chinese education has been deregulated, so that's been a very, very important milestone. And basically, in simple terms, you're now allowed to make profit if you run a tertiary education center in China. Meituan Dianping is the Uber Eats of China. They've now expanded to things like groceries and so on and so forth. China Merchants Bank is, we're interested in the securities house, as well as the fact that they are a value buy for us. And Nissin Foods is top end market instant noodles. We're not buying into a portfolio that's got incredibly high levels of P, very, very reasonable. And you also notice that as the years have passed, dividend yields on our portfolios have also grown, not because we're specifically targeting a dividend income strategy. This is, as you know, we are a capital growth strategy for your investors. But what you see here is that dividend yield has increased because Chinese businesses and across Asia are maturing more and obviously moving towards higher dividend payout ratios over time. Where we've made money for your investors over the last 12 months, ending October, we're very, very transparent. These are the names that are making the money, okay, and making the money for your investors at the end of the day. For the China fund, being our flagship strategy, some of you can ask me, why do we hold negative cash? That's not the case. These are month-end figures. We were closing out our currency hedges. So for most of you, we have a active currency hedge won by Macquarie Investment Management. But what you see here is that similar sort of theme, right? Consumer discretionary, IT, and consumer staples here is making up sort of 2/3 of the portfolio overall. So we're very, very happy with the way the performance has been, as well as where we think things are going to go into the future. Very similar sort of top holdings here. Obviously, we don't have things like Samsung Electronics in the portfolio here, but Pinduoduo is sort of a second tier e-commerce player, sort of trying to compete with Alibaba. And we've got Gree. You may have seen Gree, for those see a number of the Kiwi advisors on the call today. Gree you would see up near the Langham on Simmons Street or Avenue. There's a big Gree sign. So they do fridges, air conditioning, things like that. Very big competitor to another business which has got quite good penetration in Australia and New Zealand called Hisense, also a fully Chinese business. And again, P's are slightly higher across this portfolio, mainly because our concentration at Tencent and Alibaba is higher. So you got 16 and 10 here versus in our Asia fund, it's 8 and 8 or 9 and 8. And also to confirm, a lot of people say, hey, you're supposed to be value style. Yes, we are, but we're relative value. We're not deep value. This is independent data out of the Morningstar style boxes. What you see here is that we are a blend. Okay, so we are aiming to perform for you in all market environments. And yes, as I said before, we are more leaning towards the large cap side of things at the moment. So that's important to note, and that's because larger players have more reserves, larger players have got larger market share now, and their ability to grow and eat up the smaller players is much higher than what it used to be. Let's say even sort of 7 or 8 years ago, where we did have a higher bent towards mid and small cap names and a bit more to the value side as well. So that's important to note there. So I'm sort of bang on 12:30. There's sort of a question that has come through earlier. So the question is, does shadow banking have any influence on the previous slide results? No. And the reason being is, remember, shadow banking is related to the banking sector. We're not showing charts that are related to the banks directly. Most of the Chinese banks are held a reasonable or very material stake by the Chinese central government in some way, shape or form. There's also a whole group of non-commercial banks like the China Postal Bank that is 100% government owned. Shadow banking is a sort of misnomer that to be absolutely honest with you, I have no problems investing in shadow banking products at all. If you've ever invested into a mortgage fund in Australia, you invest into a shadow banking product. Okay, the definition of shadow banking is loans that are not issued by a bank, or it's off-balance sheet lending. It doesn't influence the results of what I showed before. And businesses now, which I'll also cover more so at 2 p.m. for those of you that are interested, I know some of you have registered for that as well, is that many Chinese businesses are very open in issuing bonds, whether it be onshore inside China or offshore, which is what the market that we participate in, which we believe we feel more comfortable at this point in the cycle. And they're all US dollar debt, more heavily vetted, and more stringent measures in place to protect investors. So that deals with that question. The second question is, what is China's net debt to GDP as a percentage? Yes, it's over 100%. It depends how you measure it. Chinese government debt is higher than most other nations. It's also, the most important point, I guess, from our perspective, is if you take on total debt, okay, so that's both government, commercial, and personal debt to GDP, nowhere near as high as Western nations. Remember that if you are ultimately concerned about Chinese debt levels and at the government level, because the corporates don't have the same issues. If you're concerned about Chinese government debt, then you should also be concerned about US government debt. The thing with the US is that they've been money printing, and at some point in time in the future, as the Chinese RMB internationalization increases, and that's just a year-on-year progress that's been very steady, and there's more and more trades of goods, services, and so forth closing in RMB, whether it be off the offshore CNY or onshore RMB, people are confident in the currency. And so if you're confident in the currency, you are also confident in the underlying economy as well. And the third question, why did CEO sell his US shares this morning? I haven't come across that news this morning myself. To be fair, I've been busy in other meetings. I'm happy to come back to you on that. I don't know if the question is, did he sell his USA shares as in non-Alibaba Holdings shares? But if he did, the only thing I would say is that he is concerned about the US regulatory environment, and that might be a sign, not sure. So I can't really comment on that. Any other questions? Okay, so we're right on 5 minutes over. So thanks everyone for attending. I'll be back at 2 p.m. to brief everyone on fixed income. And we plan on restarting monthly webinars in February next year. So if I don't speak to you before then, have a great festive season, a new year, and hopefully we'll all go through a 2021 that we can reset and completely forget about 2020. So thanks everyone.